everybody doing? You having fun? Having fun yet? Awesome. This is a good conference, right? Intimate, not too many people. Or I could say how y'all are. I actually lived in Texas for 20 years. I'm allowed to do that. So I may find my way back here someday. We'll see. So as Dennis said, I'm James Lavish. I'm the co-managing partner of the Bitcoin Opportunity Fund, and it's a fund that invests in the Bitcoin space. And unlike typical VCs in the space, our core focus is on more mature companies. We like to say real companies that are generating real revenues and real profits. So I'm not going to talk about that very much today, the fund, but we did just launch Fund 2. So if there's anybody who's interested in that, you can come up and find me at the conference, or just go to bitcoinopportunity.fund, and we'll send you some stuff, or you can find a time to talk to me there. So it's like today we're going to talk about the institutional adoption of Bitcoin. It's no surprise the world is turning digital. From books to music and photographs to how we move around the world, every single analog business has been or is currently being disrupted. And these are deflationary forces. Jeff Booth likes to say this, actually an important person in my Bitcoin journey. But they're ones that have created abundance for a lower cost. When I was a kid, I'd save up 12 or 15 bucks for from my newspaper route or mowing lawns to go get, a single cassette tape or CD with 12 or 15 songs on it, or a $5 ticket to the new James Bond or Star Wars movie. And now I can get millions of songs streamed instantly on my phone for like 12 bucks a month. I can take thousands of photos and upload them to the cloud and keep them there for just a couple of bucks a month. And I can get thousands of movies at my fingertips through Netflix just for 15 bucks without commercials. So why is the cost of everything going up? Doesn't make sense. Well, the answer is it all has to do with debt. A lot of you have heard me talk about this before. Just a few years ago, in 2020, we shut down the economy, the global economy. We ceased virtually all productivity. So look at this chart. Debt skyrocketed, up 50% in the last 8 years, and $7 trillion in 2024 alone, to $318 trillion. Over the last 2.5 years, global debt has soared by an eye-watering $30 trillion. The global debt to GDP ratio also increased by 1.5 percentage points to 328. 328%. That's 3 times debt to GDP. And it's not just emerging markets. It's even here in the US, where we have the global reserve currency with the US dollar and the global reserve asset with the US Treasury. But we have the same problem. So it wasn't just the COVID lockdowns. This has been a problem for decades. Since we got off the gold standard, debt and borrowing in the US has skyrocketed. You can see right there, the Nixon shock. And why not? There's literally nothing holding us back from borrowing ex infinitum. The debt ceiling is more like a suggestion. We all know that. It's not a limit. Both parties raise it every couple of years. Now, before we demonize debt, borrowing can be useful and important. It allows you to just pull future productivity into the present if used responsibly. But the US has not been responsible. You see the problem here? With each incremental unit of borrowing, we're generating fewer units of productivity or total US revenue since 1971. And they really exploded after the great financial crisis, you can see there. So like I said, it's not just the US. The debt disease is across the world. Any country that issues debt in its own currency will never hard default. Why? Because they can soft default through inflation. Just expand the money supply. It creates more dollars or more currency to pay down that old debt. It's easy. Now, it's fine. Investors will turn to the US Treasury as a flight to safety. It's been the ultimate flight to safety forever. But the Fed is a major driver of global M2 expansion through quantitative easing, expanding the money supply. They just dump money into the market, and they've done it for a very long time. And they do it through, straight QE. We saw them print $5 trillion in 2022. And other acronyms like the BTFP, the bank term, like the Bank Term Funding Program. But in every crisis now, the Fed and the Treasury print money. So what happens? What happens in the next crisis? Well, Larry Lepard is going to talk all about that. He wrote a great book. It's called The Big Print, and I encourage you to stay and excuse me, and listen to that. Okay. So Yellen knows it. Powell and the other Fed officials have admitted it. We are on an unsustainable fiscal path. This chart shows the debt to GDP rising exponentially, as expected by the Treasury. This is their chart. They put this out. They told the world. And look at the subtitle. It was subtitled An Unsustainable Fiscal Path. Crazy. Okay. A little bit of math here. Sorry, this microphone's a little too close. All right. I'll simplify it as we go. So take a peek at the chart. This is put out by the US Treasury. They put it out themselves this past month. It's detailing the river of flow of funds from the pockets of Americans, and from the pockets of Americans to the expenses of the US government over the course of 2024. Sorry. All right, so what do we notice first? The total debt to GDP, right? The receipts, the taxes and fees are $4.9 trillion. The total outlays, expenses are $6.8 trillion for a deficit of $1.9 trillion. We also notice that the 5 largest expenses are Social Security, healthcare, Medicare, defense spending. These total $5 trillion. So here's the problem. Mandatory expenses are Social Security, Medicare, Medicaid, things like unemployment. They're signed into legislation. There's also interest on the debt, which we must keep paying, or we default. I know, you're thinking, Trump and Musk want to cut away the fat, right? And they found plenty. They've cut $200 billion annually so far. But to get to surplus, they have to cut into the muscle and the bone. It sounds great, but here, again, this is the reality. The government spends so much, it can't even cover our interest expense. If the US government was a company, the New York Stock Exchange, it would be considered a zombie company, dead man walking. Even if we cut out defense and all other spending entirely, we're still in deficit. So you might be saying, well, that's fine. will turn to US Treasury, right? This is, people want to invest in a store of value. But then this happened 2 years ago. So who wants to own these now? A severe rise in yields caused this, and it can happen again. Investors must consider the problem the US Treasury and central banks all have. So some argue that the Fed has all but lost control the long end of the curve. You remember when the Fed lowered rates in the fall by 1%? What happened to the US Treasury, the 10-year? It rose by 1%, the yield, by the same amount, by 1%. So why is that happening? Because bond vigilantes understand that there's a problem in the system. We issue too much debt. And so they take control of the long end of the curve, expecting incredible inflation or a massive dump of treasuries on the market, and they want to be compensated for that. Why? Because they have duration and interest rate risk. So now you're seeing the long end of the curve not being associated with the short end of the curve. So as much as Bissent now has been talking about lowering rates, or Trump now demanding the Fed lowers rates, they don't have control of the long end of the curve. The bond traders do. And you guys have seen me post about that recently. All right, so getting to the meat of this. You've heard the saying that Bitcoin's digital gold. So how many people here are new to Bitcoin-ish? Anybody? A few people? All right, so most of you already know most of this stuff, so we'll buzz right through it. So you've heard that Bitcoin's digital gold, but we'll just dig a little deeper here. So the reality is that gold is analog money. Bitcoin is becoming digital money, and now it's digital capital. Neither gold or Bitcoin, should be dismissed. It's okay. Some people own them both. It's fine. But both are scarce asset and sound money. But Bitcoin has emerged as a quickly digitalizing the financial world. As Michael Saylor often says, think of Bitcoin as digital property in an extremely limited neighborhood. All right, so you hear all kinds of words describing Bitcoin, like decentralized, immutable, divisible, portable, scarce. So we'll do a really quick one-on-one on these. All right, so Bitcoin is decentralized. You all know this. It's governed by tens of thousands of nodes. Bitcoin is immutable. It's secured by the most powerful network in the world. And it's actually secured by the biggest power network in the world of 175 terawatts hours, equivalent to 20 full-time nuclear reactors running continuously. So this is what prevents the network from being being hacked or compromised, from being attacked. To give you an idea just how much energy that is, it's more energy than Ireland, Denmark, Greece, Portugal, Hungary, Switzerland, the Czech Republic, and many others. So, put simply, the Bitcoin network is a fortress of digital power that's nation-state level resistant and growing stronger every day. All right, you all have seen the pizza pie. It's infinitely divisible. So you can split up Bitcoin into 100 million Satoshis. So don't confuse that with infinite supply. Bitcoin can be taken anywhere. This is really important. It's super portable. Okay, so Bitcoin is borderless and can be sent and received anywhere in the world. Now, you've all seen the photos of people, their gold and their cash is being seized at the border. Well, I can have 1 million, a billion, or more dollars, and all I need is my 12 or 24 keys, and I can take Bitcoin anywhere. And it's not really taking it, it's already sitting there. It's in the cloud, it's on the network. That network we talked about. And Bitcoin is scarce. With a hard cap of 21 billion Bitcoin, there's an infinite supply. There's a truly limited supply. Now you can do the math. There are over 60 million millionaires in the world. So they can only have about a third of a Bitcoin each. All right, let's get into the good stuff. So you all have seen this chart before, I think. This is Jesse Myers, Croesus. So there's about 900 trillion assets in the world, $900 trillion. So how does Bitcoin fit in that? Well, you can see where gold is. Bitcoin's only 2.2% of the entire investable universe. And it's about a tenth of the size of gold. And it's done that in just over 15 years. 15 years. So some quick math. At 1% of the total global assets, Bitcoin is a $9 trillion asset, and it's worth about $450,000 per coin. And at 3%, it's about $1.3 million per coin. So make no mistake, Bitcoin adoption is accelerating, and there have been some catalysts. There'll be some more soon. So you all have seen the Bitcoin ETFs. With the introduction of them, made it really easy for institutions to buy Bitcoin. Why is this? Well, Bitcoin is difficult for institutions to buy itself because you need to have all kinds of approvals, and you have to go through like committees to get this thing approved for you to be able to buy it as an institution. Why is that? Well, you got to decide like who's going to custody it, where are you going to trade it. So who's going to keep the keys? Is it going to be the portfolio manager, the general counsel? Is it going to be, is it going to be the investment manager? So those are things that are kind of really large barriers to get over. But with the Bitcoin ETF, you can just buy Bitcoin on the New York Stock Exchange. So the ETFs, because they're spot ETFs, and you've got the underlying Bitcoin underneath, then you can just buy the Bitcoin and you can settle it just like any other stock. It's so easy. So BlackRock, Fidelity, Bitwise, and others have ushered in Bitcoin as a separate asset class for investors to add to their portfolios through the ETFs. It's really easy. All right, so it is worth noting that the Bitcoin ETFs, that just like the spot gold ETFs, but the difference is it's really easy to audit the underlying Bitcoin. In contrast, it can be pretty difficult to audit and verify precious metal ETFs. So JP Morgan had $50 million of gold in their vault, and it was found to be actually gold-plated nickel. So, yeah. So another thing is options, the options of the ETFs. So the options allow investors, institutional investors, to manage their risk around their ownership of the ETF of Bitcoin. They can isolate they just isolate the opportunity and they can hedge out the risk around it. So this is really important for institutional investors, all right, to be able to buy the ETFs, hedge out the risk around it, and it makes it easy for them to get a larger position. All right, so 1 year ago, another catalyst is FASB changed a ruling which addresses how companies can hold Bitcoin. So back in the day that Michael Saylor started buying, Bitcoin, if you put it on your balance sheet as a company, you had to hold it at the cost, the lower of the cost, or the lowest that it traded. Okay, it was treated as an impaired asset. So why is that important? Well, you couldn't mark it to where Bitcoin was marked. So if you bought Bitcoin, say at 100,000, and it traded down to 50,000, then you had to hold it at 50,000. Even if it traded back up to 70,000, then you had to still hold it at 50,000, or you had to wait until you sold it. So a lot of companies were looking at Bitcoin and they just couldn't get there. They knew that if they put it in their balance sheet, that they wouldn't be able to mark it to where it was in the market. Well, the new FASB ruling that went into effect this past December allows Bitcoin to be on the balance sheet of a company and hold it at the fair market value. So they could just market to market, which is really important. And then about a year ago, so that's a pretty good catalyst. You've seen, different companies now buying Bitcoin and putting it on their balance sheets, and that was one of the big reasons. And they'll be accounting for it properly now. But about a year ago, the SEC announced they issued some bulletin, and some of you may have heard of this, SAB 121, right? And so what this bulletin said was that if you hold Bitcoin as a bank for a customer, you had to put it on your balance sheet as not just an asset, but also a liability. And they said that you have a liability on this. And so, and if you don't count it this way, then it's kind of like it was enforcement through, enforcement through the oversight through enforcement, right? So instead of allowing them to hold it as an asset for a customer, they had to say it was a liability. So, but they knew this was wrong. They kind of did an end zone run around Congress by just issuing a bulletin. Congress then repealed it and said, you have to do this through legislation. And then because of the Elizabeth Warren anti-crypto army, it gets to Biden's desk and he vetoes the repeal. Okay, so then it went back into enforcement. So banks couldn't really deal with Bitcoin and cryptocurrency. And then Trump comes in and suddenly Gary Gensler's gone. And the SEC says, oh, okay, wait. We'll issue a new bulletin, SAB 122, that dissolves bulletin 121. And now, if you're a bank, you can hold Bitcoin as an asset. You don't have to hold it as a liability. And you don't have to hold it as a liability, especially if you have a customer that's holding it in their account. You're not really liable for it. So now this opens it up for big banks. This is a huge development that people are not talking about. Like, this is really, really big deal. And this is a big deal because now the banks can create products around Bitcoin and cryptocurrencies. And what are they going to do? They're going to create things that allow for collateralized products and for different ways for you to use your Bitcoin to meet lending products, right? And they'll be able to allow customers to buy Bitcoin right on their platform. Possibly probably other cryptocurrencies, but the important thing is that they're going to allow them to actually do it right there on the platform and hold it right there. So you're going to see Citigroup, you're going to see JP Morgan Chase, You can see Wells Fargo. I expect them all to get into the Bitcoin space pretty rapidly here. All right. I'm gonna have to buzz through these a little bit more quickly. But another thing that everybody has talked about, you just heard Dennis talk about this quite a bit. There's a lot of talk about the new strategic Bitcoin reserve that Trump created through executive order. What does that mean? Well, it means that the US is going to hold the Bitcoin it has. It's not going to sell anymore. It sold about 200,000 Bitcoin over the last 10 years. The Bitcoin that they accumulated through by seizing it from people who are doing illicit or illegal activities. So, but there's still 200 left, we think, and they're going to hold that. And that's what that executive order says. And they can also add to it through seizures, and they can add to it through budget neutral measures. So maybe selling gold. Or the other part of that executive order was a digital asset reserve, a digital asset stockpile, excuse me, that allows the government to hold those digital assets that they seize that are not Bitcoin, like Solana or Ethereum or some of the other ones that they do have those. But there's no measure in that executive order for them to add to it. So it would make sense for the government to be selling those and buying Bitcoin with it at some point. And we've heard rumors of them maybe selling a little bit of gold to buy Bitcoin too. The other big thing is the Bitcoin Act. And that actually the Bitcoin there should be fully capitalized. It's an acronym. So, but this is the act that Senator Lummis had brought forward. She authored this a little about a year and a half ago. And this is where there's a Bitcoin reserve where the government would buy 200,000 Bitcoin a year for 5 years for 1 million Bitcoin. So if you remember when the executive order was, when that was signed a few weeks ago, maybe 5 or 6 weeks ago, Bitcoin dropped immediately. Why did it drop? Because people were upset that there was no way to add to it without having some sort of legislation or selling other assets to do it. So, but this is why the Bitcoin Act is so important for the U.S. government to be able to buy more Bitcoin, and that's so this is a huge development. And the important part about this is that Senator Lummis has just reintroduced the bill, and she's got multiple co-sponsors for it. So it looks like it's going to move forward. I don't know when, I don't know how long it'll take, but it's a really big positive development in the space. Okay, I got to hurry up here. So this all says that there's a lot of momentum in Bitcoin. There's a lot of tailwinds, numerous tailwinds that are pushing Bitcoin forward. So you might have noticed yesterday that when the Bitcoin, when the market dropped, everything was down, from the tech stocks to the S&P 500 to the Mag 7s. Gold was down, like everything was down except Bitcoin. Bitcoin kind of decoupled yesterday, which was very interesting. It's really important. But over the last 10 years, Bitcoin has outperformed every single asset class that you can think of. It is greatly outperformed. So this is Bitcoin price in Bloomberg's US Treasury Index over the last 10 years. And it moved from being priced at roughly 0.1 of the index 10 years ago to 25x that now. Okay. I mean, that's devastating for bondholders, right? Gold is a similar story. Gold has outperformed it a little bit earlier this year, lately, but Bitcoin has gone from being priced at roughly 0.3x of an ounce of gold to 27 times an ounce of gold now. So what about risk assets like stocks? Well, here's BTC priced in the S&P 500 total return index, including dividends. Bitcoin has gone from being priced at 0.1 of the index to over 6.7 times. And for those who are wondering about the high flyers, the Mag 7s, the ones driving all that S&P performance, here's Bitcoin versus those. So it's gone from being roughly priced at 0.25 of the Mag 7 to 3.6 times now. That's great, you say, but look at all that volatility. It must kill your returns, right? The volatility. Okay, so I ran these numbers. And if you look at a traditional 60-40 portfolio, 60% equity, 40% bonds, which is supposed to, it's supposed to dampen your volatility and protect you in drawdowns in the markets. If you just add a modest allocation of Bitcoin to that 60-40 portfolio, okay, so the bottom line there, you can see that blue line at the bottom, that's your 60-40 portfolio. If you had 1%, okay, you enhance your returns. If you add 5%, you double your returns. And if you had 10%, you almost quadruple your returns in just over 10 years. Okay, so, but again, I know what you're thinking. You look at this, you say, look at those drawdowns, like that volatility must be terrible for your portfolio. The short answer is no. Okay, there's a ton of data here. So I don't want you to freak out. We'll go through it really quickly and easily. But the important thing here is the Sharpe ratio. Okay, so what's your Sharpe ratio? Your Sharpe ratio it's your risk-adjusted return. It shows your returns with the volatility. So it shows how your returns have done adjusted for all that volatility in your portfolio. Okay, so if you just add 1% of Bitcoin to your portfolio, these are the numbers that you're looking at here, okay? You would enhance your returns by 1%, your annual returns by 1%, and only increase your volatility by 5 basis points. And this increases your Sharpe ratio. By adding 5%, it's even better. Raising your total return by 150% and your annualized return by over 5%, your volatility only increases by less than 1%, and your worst drawdown is just 2% more than with no Bitcoin at all. And finally, by adding 10% of Bitcoin to your portfolio, your returns increase by 374%, pushing your annualized return to almost 20%, 19.4%, a bump of over 10%, okay, annualized with no Bitcoin. And your Sharpe ratio jumps even higher to 1.28. And that's the magic number is 1.0. So if you get your Sharpe ratio over 1.0, that's kind of your magic number. Now you're 1.28. And your largest drawdown is only 5% higher in the worst market. So in a word, it's compelling. All right, so let me leave you with this. This is a chart from last year, a year ago. I have to ask them to update it. But if you add 2024 to this, Bitcoin outperformed again. So it would outperform 9 out of the last 12 years. It'd be the best performing asset. So Bitcoin is slowly moving out of the risk to own category and into the risk to not own category, especially for money managers and institutional investors. So let's put it this way. I wouldn't want to have to explain to my clients and my LPs why we didn't own any. And thankfully, that's not a conversation I have to have. And I hope that if you're a money manager out there, that you don't either. And that's it. Thank you.